Welcome to the third episode of DeFiner's Office Hours AMA, a bi-weekly show where we discuss DeFiner, DeFi, and answer questions from the community. On this week's show, we discuss DeFiner 2.0, a permissionless debt market with multi-chain support, with founder and CEO Chyna Qu and co-founder and COO Chyna Qu. Today's episode will be released in two parts. In part 1, we discuss DeFiner 2.0 in greater detail, but as a bonus, we will release part 2 next week featuring our community questions. Thanks for watching, and make sure you subscribe so you can keep up to date with all things DeFiner. Welcome to the third episode of the Office Hours AMA, a bi-weekly hybrid AMA series where we talk about the pressing matters at DeFiner and in DeFi, including questions from our community. Today, we're going to be focusing on DeFiner 2.0, our latest offering. Jason, Chyna, welcome. Thanks for joining us.
Thanks, Adam.
No problem. Why don't you give us your best elevator pitch for DeFiner 2.0?
Yeah, for sure, Adam. So DeFiner been in the DeFi area for a relevantly long period of time. So I think we understand what's the current issue is there's no such an open market for lending market, because current available lending solutions, they are still very centralized. Like there's a central party to keep the gate, like which asset can have an open pool, which asset cannot. So that's why the current popular solutions you can see on the market only provide tokens for lending pool, like a very handful, like less than 20. However, there are over 6,000 tokens listed on the market, called market cap, right? So there's a reason why, because the current lending model is based on standardized product, which all the assets in the lending pool share the same risk. That's why it's so hard to add more different level risk of tokens. That's why it's not as scalable as possible. So that's the problem we see on the current market is there's no such permissionless and configurable solutions for lending and borrowing pool. So that's why the DeFiner have a unique position to bring the market truly permissionless, which means anyone can list their token as collateral, can have a lending pool and borrow and lend. And also it's 100% configurable. What does that mean? Means depends on the risk level, which is the the volatility of the price of the token, and they can configure it to different collateral factors, interest rate range, and the different reward system. In this way, it will be fully configurable, and anyone can create their own pool. But at the same time, if such pool are all separate or isolated from each other, it may not have good liquidity. So in DeFiner, we have unique design. Even it's a independent pool for the specific asset, but the the different pools will connected through our DeFi savings contract, which is more like a money market. Then in this way, you will have a fully configurable lending pool and for your own asset. At the same time, you will also have good liquidity. So that's really about DeFiner 2.0.
You mentioned something, it's called the initial loan offerings. Can you go into more detail about that?
Yes. So for initial loan offering, it's just the one application, right? Like more like initial DEX offering, like when project they are going to list their token and trade on the market, it's usually have a primary market, which they selling the token to the private investors. However, not all the investors have a lot value to help the project to grow, but except the capital. So in this case, we want to open up platform for the startups, especially the crypto and blockchain startups, give them the option to raise money through debt instead of selling their tokens. Because in current market, the price of their token on the secondary trading market is usually much higher than the price in the private market. So in this way, the project can borrow money from our lending market and use their collateral, which is their unissued token, as a collateral to borrow against. And in this way, they can raise money easily from the community. And then we also help them to distribute, to as many community as possible. And then, there's very little risk, because even, at the end of the default, the community actually get a discounted private sale price, which, they do not have an opportunity to get before. And for the project, they don't need, we can have them lock up the liquidity. Also, we give them an opportunity, to keep the token and to have sell it at a better price once it gets listed. Mm-hmm. So that's the idea we call initial loan offering, which is allow the project to raise fund through debt, which is use their unissued token as a collateral to raise money from the platform, instead of selling it to the private investors.
Kind of like a raising function for different communities that perhaps want to use our platform to sort of build on.
Yeah, and it's like a crowdfunding through the debt, all the loans offering to the public. Also, as we just mentioned, like DeFiner 2.0 will be fully configurable and open to anybody. So startup project are perfect use case to use DeFiner 2.0.
Also in DeFiner 2.0 China, we talk about sort of a multi-chain future with the OKEX chain being the first that we're migrating to, but we also talk about Binance Smart Chain, Solana, Wobi, EcoChain, and Tron, and Polygon, I believe. Can you give us a little information about what our potential multi-chain future might look like?
Yeah, so I think, the burning pain for everybody right now is the Ethereum high gas cost. I mean, it's not new to the DeFi players. To us is that, DeFiner wanted to build a community-oriented product as well, because the current high gas cost is not very beneficial to the communities. Mm-hmm. It makes sense for institutional, like if you're doing a large fund, but for retails, it's just not friendly. So that's why we're starting to explore the multi-chain route. Mm-hmm. And then OKEX chain, that's our first attempt. Mm-hmm. I think, we wanted to start it off with OK chain. It's just a strategic move. Mm-hmm. I think from, resources wise and marketing perspective, we can get a lot of support from them. And then, also they have a very good community base. So it's a win-win situation for the both of us. And then, obviously we're not going to stop here. There's more that we wanted to integrate along the way. You mentioned the BSCs, Polygons, Solana, that's all down the road. So we'll share a little bit more information with the community, once we have a solid plan that's going to come out.
Jason, we did have a DeFiner 2.0 blog posting, and we had several pieces of artwork describing DeFiner 2.0. I have this one up on screen about the savings pool. Can you go into more detail about how this works and what it is?
Yeah, absolutely. So as you can see, we have savings pool, which is the DeFiner 1.0 in the middle, and that will still be the hub you can consider, because it's connected with many child smart savings pool. So in each savings pool, it's actually a debt market for specific tokens. However, they all need to connect it to the current DeFiner 1.0, as we want to aggregate the unused capital. In this way, you have each, the child pool or each child debt market will have good liquidity. here it just a simple list of several applications. Again, as we mentioned, it's a truly permissionless and open protocol. So everyone can have a token listed and use as collateral. For example, the one initial loan offer we just talked about, here we put it in the top right, primary market token, debt market. So, there are going to many projects, they come to the list tokens. And then we connected this with our big saving pool, use the lending currency, which is USDT, USDC, stable coins, or some blockchain native currency like Ether or BNB. That can be used as the lending currency. So if there's any unused capital, the lending currency will deposit automatically to the savings pool. People in the savings pool, they can still use that and generate interest. And however, we can also have different risk level and define the credit of each smaller pool. Start with 0, which means they cannot borrow from the bigger pool, but they can use all the funds available in their own pool. So, and that's just one implementation. Another one is, the NFT. Each NFT token can have their own pool, right? And they can come DeFiner and create NFT-backed tokens, and they will run the campaign. Some users, because of a high interest, and they may, lend money to the NFT token owners, and again, it's all connected with the bigger savings pool, as you need to manage the risk properly, but at the same time, we need to have good liquidity. So in this way, it will be available for a lot of applications, right? Like we make the credit loan available, because you think about the credit loan, it's not a non-collateralized, it's more like a collateralize your reputation and credibility. So as long as people trust you and the people who near to you know you, like they believe you, so they will recognize the value of your tokenized reputations, then you can actually offer credit loan. Also, you can offer loans to a lot of LP tokens. Each LP tokens, right now there are a lot of LP tokens, and they are kind of these liquidity tokens. But within our debt market, we also make it available. So that's just give you several idea how scalable of our DeFiner 2.0, which means it's a truly permissionless based and suitable for any asset tokens, and but at the same time, it has sufficient liquidity and the risk properly managed, because also truly configurable product. Yeah, this is about what this chart talking about.
And can we take a deeper dive into sort of debt markets, startups and defaults, that sort of thing? Can you kind of help me understand the DeFiner 2.0 default process, how that might work?
For sure. So let me bring another chart, show my screen.
Yeah, let me.
So this is more technical, the process, how it will make you feel how it works, or make you clearly understand how the process looks like. Mm-hmm. So at the right side, you can see here we have the borrower, which, let's use the initial loan offer as example, which is a startup, blockchain startup who has just closed, their lead investment, private sale for one lead investors, and they have a date set up for their token to list, either do IDO or Uniswap or other centralized exchange. But probably they are going to do that within next 2 or 3 months, right, time frame. And right now, they all raise money from the private investors. Some of them give them a lot of help, and some of them only give them capital. So we see they can use DeFiner to raise the same amount of money, and but at the same time, they don't need to sell their token. So which means they have less, they have less token available on the market, which they lock it within the contract. But once the token go alive, they can sell the token at a much higher price in this current bull market, and then they pay back the loan. So for the lender, which is community member, usually they don't have opportunity to access their primary market tokens, before they are listing. So in this way, they have opportunity to get the token as an interest paid or as a reward. And also, they have opportunity to enjoy and the appreciation of the token. At the same time, they will have the project to promote. So how it really works is the blockchain startup come to the platform. They enable the token spending limit, and then the MetaMask or the wallet will pop up, and they just create their debt pool based on the configurations, which we will ask a bunch of questions like what's the collateral factor looks like, which means what's the percentage you want your collateral to be used to borrow against. Like what's your interest rate range, right? Like you may give like a 10% or 20% or 30%. There's a range, and then what's the token rewarding looks like, and also how long you plan to repay the loan. So that's all the kind of sort of questions that will be inputted into the smart contract, which is we call it the parent debt market, which is the key for the DeFiner 2.0. And this smart contract get all the configurable information from the startup, and they will produce a child market specifically for the startup. So now, for example, if we startup A have a token, then the child market is available for a token as a collateral, and then they will run a campaign. We also have the project to run a campaign. And the lenders, which is the community member, they saw this opportunity, high pay of interest and the least risk, because even the project default, the lender have a right to claim their underlying asset, which is their token at a discounted private sale price, which is is awesome for the lenders as well. Then once the lender deposit the token to this specific debt market, and the blockchain startup can borrow the token, and also at the same time, they can repay the interest in terms of US dollar. At the same time, they also reward the lenders with their project tokens, which they have more potential to grow. So this is just a simple process to lay out how it works. And what if the the lender want to exit earlier, right? They can actually swap their position on a secondary trading market. In this way, even I lend you some money, and for probably several weeks or a month, but if I want to exit earlier, I can swap it on the secondary market. And if liquidation happen, what does that mean is, they didn't pay back, there's a default, the price go down, then there is going to be a liquidation event. And in that case, the lender will claim the underlying collateral from the startup. If the pool has enough liquidity, US dollar, but is unused, for example, the startup only want to borrow 600,000, they pledge in $1 million worth of collateral. And if there's more available capital, and the capital will automatically deposit to the DeFiner savings pool. And if there's need more liquidity, and they can just withdraw from the savings pool. In this way, they will have a good liquidity, better risk managed, and based on the different configuration and the risk level, also have generated more returns. So this chart, will help you better understand how exactly it will work.
I've been kind of looking at the DeFi space, and everything seems to be on a collateralized loan basis. I'm just curious for both of you. Do you see a future in DeFi that will have a non-collateralized loan for the cryptocurrency space?
The credit loans, is actually not non-collateral, right? Like in the real world, we have credit score, and if you don't pay, your credit score will drop, and that's kind of history. So I think in DeFi, definitely, actually, our market is designed for that in the future, right? So you can tokenize your own credibility, and you can have your own web page to market that. This is who you are, and this is your credit. The repay the history, and this is a personal information. I mean, as long as people trust you, they know you, they will lend money to you, right? They can use, then you can come to DeFiner, create here, what I call it the child debt market for you, like for Adam, and as long as your friends or relatives or whoever trusts you, they will lend you the money, and actually that will become a credit loan, right?
Right.
And yeah.
One of the community questions was, how will this DeFiner 2.0 benefit the community? What would you guys say to
that? That will benefit the Fin token holders a lot, and because think about like the current most successful project, they are all the center of other projects, right? For example, Uniswap, when we list token on Uniswap, we promote Uniswap because we promote it to our community to buy our token on Uniswap. But in current lending market, there's no such center, for the project. As I mentioned, it's only available for handful project, right? Like 20 projects. So we have 6,000 projects over there. So DeFiner token holders, we will become the center, the project will promote, and at the same time, they will promote DeFiner. Also, DeFiner Fin token holders have the governance right to the, all this configurable design, fees, because, in the lending platform, we charge us a percentage of fees, which is the interest generated through the platform. And we once we engage more projects, they will raise more money. That will boost our TVL. That will also boost our interest revenue, and then we will use all the interest revenue and to repurchase back Fin tokens. So from economic level, the Fin token, once we have more revenue, the value of Fin token absolutely will go up. At the same time, the Fin token holders can once we have the DAO release, they can vote and to control the overall protocol. So because the overall protocol will become very important, play a bigger role in like a configuration design, liquidation design, etc.
Well, on the same token, what are the risks of this potential?
There's a default risk, and what if I lend you the money and the startup get the money and startup didn't pay back, right? Mm-hmm. So that's the worst scenario. So in this case, even the worst scenario is better. It's not too bad for the lenders, because usually lenders hardly get private sale token price. So usually they buy the token from the market, secondary market. So the price already much higher than the private sale price. So in this case, even the startup didn't pay back, but I think most cases they will, because they will protect their reputation. In the future, they can use this as a staking. People who ever own their token can come here and deposit and earn interest. Also, they can borrow money, right? So that will help the startup a lot. So I don't think they have a incentive to default. But even they default, the community members will get the discounted private sale token price. So it's a win-win situation. So if the project grow pretty good, they will never default. and actually they will pay you a very high interest because the token will appreciate. Also, there's a lot of value for them, so they will give you a lot more higher than average interest. And for the lenders and even the startup default, they will still get a discounted price. So it's a win-win situation. So that's why I see it's one of very important use case for DeFiner 2.0.
So the vision that came behind this, how did you come up with this idea of that?
Again, this idea came from in current DeFi market, we still do not have a truly decentralized permissionless debt market. And in DeFiner 2.0, so that DeFiner 1.0 is the fundamental, because as you can see, all the child debt market connected through the DeFiner savings pool, because we need to aggregate that. And after we have built up DeFiner 1.0, DeFiner savings pool, we need to make it available for all the tokens, all the crypto assets. So that's how the idea came from. So how can we serve as many tokens as possible? So currently, for current available lending product, there's a problem, right? The problem is they pool all the different kind of risk level token into one bigger pool. So that's just not sustainable and scalable, because the default risk is different. You cannot mix high risk asset to a very good asset, because the high risky asset, they may get the fund away from the bigger pool. So they hard to manage the risk. That's the reason why they cannot open it for any tokens, any asset. And we saw this problem. And the DeFiner, we are DeFi innovators, and we want to help this industry to resolve the problems. So then this idea came from, we need to separate different risk level, or we need to have different token has their own smaller pool, but they need all connected to a bigger pool and to make sure they have good liquidity. In this way, we can properly manage the risk level of different smaller pool, and ensure different smaller pool properly manage the risk, and provide a proper interest, and also as open as possible. That's the how this idea generally from.
Privacy is a big issue for the crypto community, and you describe a new function within our smart contract that will enable users to transfer their balance of their contract without disclosing any information. Can you give us more insight about this feature, or maybe any mechanics of how that might
work? So again, I think it's start from a problem on current DeFi landscape, right? Blockchain is good. Blockchain, everything is transparent, and you can trace the history of transactions. And but it has another side, privacy, right? Because this is all financial information. Do you really want others to watch closely of your payment, your loans, your debt, all these things, right? Probably the answer is no. But then you may argue, hey, it's all anonymous, and you will never find me. You never know who I am. But that it's a data world, right? When you do data mining, cross comparing all the information, the IP you use, the exchange you use, the phone you use, the email you use. So then they can quickly define who you are. At least they will probably get an idea of who you are if they consolidate all the information, right? So it's not 100% anonymous. So when you handle bigger amount of dollar, you may worry about privacy, right? So I think that's a problem. Right. And for DeFiner, how we want to address it, within our savings pool, which we aggregate all the deposit, then lend it out on the money market, and then we can make it private. what I mean is, we can make it, we can cut, because, for example, on-chain transaction is all traceable. So when you come to DeFiner, once you deposit to DeFiner savings pool, you can do an internal transaction to transfer your balance from your wallet A to wallet B. And this process is encrypted. And only the people who have the encryption key can get the deposit, your balance transfer. So what I mean is, consider DeFiner savings pool is more like a black box, and you can deposit money in from a wallet A, and you can withdraw it from another wallet, and people will not get connections for those two wallets you have. Or even you can get from one wallet, you can get the money out from 10 wallet or 10 wallet address, or as many as possible as you want. The design is, we want to keep you 100% financial information privately. So in this way, people hard to trace you on the blockchain, because once you get in, then you get out your money from different wallet. They have no idea and associate from your previous transactions. So in this way, I think it's a good use case for this whole industry, like because it's all financial information. You want to keep it privately. So that's how we think, we believe this is important, and it's also part of the design of DeFiner 2.0.
Yeah. We also touch upon the DAO, a decentralized autonomous organization, and sort of our vision for where we would like to take that. Can you give us maybe not even just like a very specific one, but maybe an idea of where that is, or how you see that working out in the future, like how the community will interact with a voting system and all that kind of stuff, proposals and things of that nature?
Mm-hmm. Yeah. So, at DeFiner, we truly believe decentralization is the key to success for blockchain-based, financial system, because that will make things automatically and reduce a lot of cost, and also bring the trust elementers to the product, right? So at DeFiner, that's our automatically goal. So, but once the product reach a mature level, it can, it's fully run automatically. Then there's a lot, the protocol like a country, right? There's a lot of decision need to be made, like how much interest rate, share you want to charge, 10% or 20% or zero, right? Do anyone need fin token first? Then they can start to use the platform. All these kind of sort of decisions, proposals, and the community will find very interesting. They will think, what's the best protocol they are using, and they can propose. They can manage the protocol, and they can have the authority, but it's a decentralized authority based on the community. And because the knowledge for DeFiner team is limited, but the knowledge from the community, from the world, is unlimited, right? So we want to bring that element. We want to bring a discussion forum. We want the community start to propose and to build the protocol. And in this way, we will have much better, community, and much more decentralized lending protocol. And it's suitable for everyone. So that's kind of an idea and philosophy behind the DeFiner DAO.
So Chyna, we've gone over DeFiner 2.0 in some detail, but there are also some new stuff in DeFiner 1.0 that's actually quite exciting, especially for the Ethereum universe. How gas costs have been out of control in the last couple of months. I mean, they're starting to go down with the Berlin hard fork upgrade and that kind of thing. But at the platform, our CTO was able to sort of decrease the gas costs by almost 50%. Can you tell us a little bit more about that?
Yeah, sure, definitely. I think, just now we kind of mentioned about our multi-chain initiatives.
Mm-hmm.
By the end of the day, it's all about our community. the matter of solving the high gas costs on Ethereum it's something that the whole ecosystem then need to work on. But then on our side, we're thinking, what can we do about it? So that's why, within the product, we're doing an upgrade. And then the upgrade was very successful. We're able to reduce the gas cost as high as 50%. And actually, with what you just mentioned, Adam, the burning hard fork, it actually reduce the gas cost even more.
Yeah.
So we're very excited to roll out this product. What we're thinking about for the community is that we'll do some a gas fee compensation, a gas on our side as well. Right. Just to encourage users just to try out the product, because before it was just too high of a cost to bear for a lot of the community members. So we're very excited about this new versions of the reduced gas fee cost.
Yeah, that's very true. I mean, there's a lot of retail investors that got priced out of just using DeFi over the last couple of months because you're getting $40, $50, $100 transactions on like $50. It was just kind of insane. But that's kind of the thing that happens when the Ethereum network gets clogged. But it seems like they're starting to get it under control. But it's really cool that with the multi-chain future, you're saying the reason why we've moved to them is to help the community so that we can get retail investors in there and that we can make sure that anyone can use the protocol and become a community member. Would you say that's an accurate statement?
Yeah, definitely, for sure. Everything we do is for the community. It's a matter of how we can reduce the cost for them, how we can benefit them furthermore. Even with the DeFiner DAO, the DeFiner 2.0, it's all for the community by the end of the day.
And there's one other development from the 1.0 is the mobile app. Do we have any information on when that might be coming?
Yeah, so the mobile app, the mobile app, we're almost ready. I think we'll be meeting with everybody in the summer. So I'll say coming soon. We've been doing some internal tests recently, some UI design improvement as well. I'm very excited for the mobile app because there's an internal wallet that's built within the apps. You don't have to connect to other wallet. You can have your own DeFiner wallet. Saves you a lot of hassles. Beautiful designs, just like our platform. So yeah, more to come.
Great. And you guys, I'd like to kind of wrap this up. I did this last time with Tom. I asked him specifically, and I want to ask you both. I'll start with you, Jason. If you could provide a pearl of wisdom or any sort of alpha or any kind of great advice for anyone in the community, what would you offer?
I will say do your research and stick. Once you made your decision, stick with the community you're choosing and grow together with them.
Great. Chyna?
Yeah.
Come to DeFiner.
Yes, please come.
Yes. But yes, just to echo what Jason just said, I mean, there are a lot of very exciting things that's happening within the space. But not everything is 100% true. So do your research, stick with the right community. I mean, if you're watching this video, you're in the right crowd. You are on the train just for the next generation of internet. So you choose the right place, choose the right project, stick with the community, and we'll grow together, grow and thrive together.
Great. Thank you for that. Thank you both for joining me. And we'll actually have a second part to this where we'll be answering more community-based questions. But we wanted to talk specifically about DeFiner 2.0 today. So, Jason, thank you very much. Chyna, thank you for your time. And have a wonderful.
Thank you.
Yep, no problem.
You too.